Hello, Mark Sturdy here with another snippet of our weekly research in major world markets. And look at our summary sheet. There were a number of things I could have chosen. The bearishness of the dollar, of the sterling, and the yen in particular against the dollar. We think that's been given a great impetus by some broken levels, but I could have chosen the bearishness of the Euro Stoxx 50, which we talked about, I think, last week. The higher yields we expect in the T notes, but in fact, I could have talked about that, but in fact, we're going to talk about gold. Gold, an old favourite of ours, because things have happened that I think have borne out our somewhat bearishness over the last few months. We have long-term been doubtful of the gold's ability to hold itself above 1915. It's failed once, twice, and now we think it's failing for a third time. We were greatly encouraged in the weekly chart by the completion of a head and shoulders reversal. The completion of the reversal here on this some weeks ago, maybe 4 or 5 or 7 weeks ago, in fact led to a sideways movement, rather disappointingly for the bears, such as us. But at no point was the market able to break back through the neckline, this line here, of the head and shoulders top. And as we can see, last week there was a serious breakdown, obviously long implied by the head and shoulders reversal, which incidentally calls the minimum move down to 1750. But for the purposes of last week, the important breakdown was to break down beneath these two prior lows, the horizontal band of support, which might have been building up, and that was unambiguously smashed last week. So we had the fairly short-term move down beneath these prior lows and the medium-term top formation implied by the head and shoulders top, and the long-term scenario of repeated failure above 1915. The bears are in charge, and the last week we also spotted this triangle which had completed, and that led to the speedy collapse of the market down to 1870 or so. We are now beneath that level, so the influence of that triangle, which was the catalyst for the sell-off, is rapidly diminishing, but it set the tone and reinvigorated the power of this pattern here, and which calls, as I've said before, the market very much lower. So there may be short-term pauses because of the lack of impetus immediately due to this triangle, but the medium-term picture is unambiguously bearish down to at least 750. That's not a minimum. That's not a maximum, it's a minimum. That's to say, it could very well go lower, given the impetus. Thanks very much.